Wow, this is just absolutely crazy. Welcome to today's explainer, everyone. Look, we are looking at a legacy tech titan today that just saw its stock price completely fall off a cliff. We're talking about a massive, jarring 20% drop in market value since early June. I mean, for a company the size of IBM, that is a staggering amount of wealth just wiped out in a matter of weeks. But here's the thing, when you actually start digging into the Q1 2026 numbers, something really doesn't add up. The headlines are out there screaming panic, but the company's internal engines, they are quietly roaring. So to help us make sense of this, I've got our chief investment analyst here to help us separate all this emotional noise from the cold, hard data.
Thanks for having me. And you're absolutely right to point out that disconnect right away. Because when we look at the actual numbers reported in the first quarter of 2026, the market's reaction appears entirely detached from IBM's fundamental performance. If you look at the data, we are clearly dealing with an emotional contagion event here, not any kind of fundamental breakdown.
Okay, well, let me play devil's advocate right out of the gate. A 20% drop is not just some minor correction. That is a full-blown market panic. You don't just lose a fifth of your company's value unless institutional investors are terrified of something. So wait a minute, doctor. What does Accenture's recent problem have to do with our stock accounts if we hold IBM? Are they basically the exact same business?
No, they are absolutely not. And that is precisely where the market miscalculated. The data clearly shows that this sell-off was a contagion effect. If you look at the sector reports from June 22, 2026, Accenture cut its revenue outlook. Now, that specific announcement from Accenture infected the entire IT services sector with fear regarding slowing demand for discretionary IT and AI consulting projects. The market just immediately priced in a worst-case scenario for IBM, assuming they would suffer the exact same fate because, well, historically, they were viewed in a very similar light.
So wait, they just dumped the stock, basically because of the neighborhood they live in?
Precisely. But the numbers prove that IBM's business mix is fundamentally different today. Consulting now accounts for less than a third of IBM's total revenue. The market punished them for an IT consulting slowdown while completely ignoring that IBM has successfully transitioned into a software-led and AI infrastructure platform company.
Wow, really? So they literally got grouped in with the wrong crowd? But even so, if things were truly fine internally, wouldn't their financial safety net have caught them before a 20% drop?
Well, the financial safety net is incredibly robust, which is exactly what makes the panic mathematically unjustified. Based strictly on the Q1 2026 earnings report, IBM generated a massive $2.2 billion in free cash flow. That is actually up $300 million year over year. In fact, Chief Financial Officer Jim Kavanaugh explicitly stated that this represents their highest first-quarter free cash flow margin in reported history.
Wait, the highest in their entire reported history? No way!
Exactly. The numbers absolutely prove it. A business whose core model is failing does not print record-breaking cash flow margins. So today we are going to look past all that market emotional reaction and examine the three real causes hidden behind the headlines. First, we'll look at their actual financial reality. Second, the undeniable expansion of their economic moat. And third, a massive, unpriced regulatory catalyst that is fundamentally altering their trajectory.
Okay, that is a wild setup. So here is our structured roadmap for today's explainer. We've got Stage 1, introducing the issue. Stage 2 is our financial deep dive. Stage 3 covers that economic moat. And Stage 4 breaks down 3 strict survival scenarios. Let's dive right into this. All right, Stage 1, the misunderstood giant. So before we even look at the spreadsheets, we really need to clear up what IBM actually does today without any of the crazy technical jargon. Absolutely. So think of the modern corporate world as a massive, sprawling city. Every single business is a building in that city. And right now, they all desperately want to install the newest, flashiest electricity, which is artificial intelligence. But here's the problem. Their buildings are old, and their wiring is a chaotic mess. IBM is essentially the master electrician and the connective plumbing company. They do not sell the flashy light bulbs. They build the secure, custom wiring inside the walls so that the entire building doesn't burn down when you plug that new AI in. Now, the market perception right now is heavily weighted toward that Accenture IT drag and the slowing consulting narrative. But the IBM reality, which is proven by their Q1 2026 data, is a software-led platform holding a massive $12.5 billion AI backlog. Oh, wow. So what you just said basically means the market thinks IBM is just some old-school consulting firm, when in reality, they are a software powerhouse hoarding literally billions in signed AI contracts. Correct. And it's crucial to note these are not vague pipeline projections. The earnings data specifies that these are executed agreements, with customers deploying AI in actual production environments today. Moving right along to stage 2, the financial deep dive. But look, I have to throw a flag on the play here. If their financials are so bulletproof and they are the plumbing of the AI world, why wouldn't buyers just step in and buy the dip? Show me the actual numbers. Let me break this down for you using the exact figures from their Q1 2026 financial statements. The institutional buyers will eventually weigh the fundamentals, but right now, they're blinded by sector-wide macroeconomic fears, specifically higher interest rates and that Accenture guidance cut. But if we look at the actual income statement, the foundation is incredibly solid. In Q1 2026, IBM posted $15.9 billion in total revenue. That represents a 6% year-over-year growth at constant currency. Furthermore, we are not just seeing top-line growth. We are seeing extreme operational efficiency. Their adjusted EBITDA margin expanded by roughly 170 basis points, and their pre-tax margin expanded by 140 basis points. Hold on, 170 basis points of margin expansion? So that's basically 1.7% of pure extra profit margin on $16 billion? That is massive. How are they expanding margins that much while the rest of the industry is complaining about slowing demand? It is driven by what CEO Arvind Krishna and CFO Jim Kavanaugh detailed as productivity savings and portfolio mix. They have successfully executed a repeatable AI-enabled transformation engine internally. The data shows this has driven $4.5 billion of productivity savings since 2023, with an additional $1 billion expected in 2026. They are literally using AI to make their own operations leaner, automating HR, finance, supply chain tasks, and it is showing up directly on the bottom line. Okay, so the overall company is growing and getting way more profitable. But if I am an investor, I really want to know exactly which engines are pulling this train, because clearly, based on the market panic, something has to be broken somewhere.
Well, this data isolates the exact cause of both the growth and the market's anxiety. Let's look at the segment growth. Infrastructure revenue grew by 12% to $3.3 billion. Software revenue grew by 8% to $7.1 billion. But look at consulting right here. Revenues of $5.3 billion grew by only 1% at constant currency.
Ah, there it is. The consulting segment is basically flatlining.
Precisely. Consulting makes up about a third of their total revenue, and clients are clearly remaining highly cautious with new discretionary projects. They are putting off the big, experimental build-outs because money is just very expensive to borrow right now. However, the logical interpretation of this data is that the high-margin segments, software and infrastructure, are drastically outperforming and completely offsetting that consulting drag.
Okay, so what you just said basically means their software division is essentially carrying the team. But wait, we see software companies boast about growth all the time, right? And then it just fizzles out when the hype dies down. How durable is this 8% growth really? Is this just a one-time blip?
The numbers indicate very high durability. If you look at the breakdown of that $7.1 billion in software revenue, their annual recurring revenue, or ARR, stands at $24.6 billion. That's up 10% year over year. That is highly predictable, locked-in cash flow from long-term subscriptions. During a macroeconomic downturn, that ARR provides a massive defensive floor. Furthermore, their data segment grew by an impressive 16%, and Red Hat growth accelerated to 10%, with OpenShift ARR now hitting $2 billion. This isn't a one-time blip. This is structural recurring revenue driven by enterprise clients modernizing their core systems to handle data securely.
Okay, recurring software revenue, I understand. That makes sense. But what about the hardware side? You said infrastructure grew 12%. I thought hardware was a dying, low-margin business.
That is a very common misconception, but the data tells a completely different story. Look specifically at the IBM Z mainframe segment data. It surged by an astounding 48%.
Wait, 48% growth on mainframes? Are you kidding me? Who is out there buying mainframes in 2026?
The largest financial institutions, airlines, and governments in the world. As AI workloads increase, the need for end-to-end encryption, continuous availability, and ultra-high throughput absolutely skyrockets. These organizations are processing billions of highly secure transactions a second. The Z17 cycle is vastly outperforming prior cycles, specifically because it is an AI-enabled platform designed for these extreme computing needs. Furthermore, distributed infrastructure grew by 13%, reflecting a massive demand for IBM's highly secure data storage solutions, like the Flash system, as generative AI eats up vast amounts of enterprise data.
All right, let's jump to stage 3, industry environment and economic moats. In an industry that is utterly obsessed with flashy, consumer-facing AI like ChatGPT, what is IBM's irreplaceable weapon to avoid getting crushed by the competition? To understand their economic moat, we really must look at the core objective of enterprise AI. The basic role of enterprise AI isn't just generating fun images or summarizing internet articles. It is securely orchestrating proprietary data, models, and workflows across a massive, messy, hybrid environment. IBM's irreplaceable weapon is trust, security, and governance. This is proven by that $12.5 billion AI backlog we discussed earlier. Look at the data points here on the screen. Generative AI specifically represents roughly 30% of that total order book. Furthermore, to accelerate this, in mid-June, IBM deepened a massive partnership with ServiceNow.
Wait, ServiceNow? What does that have to do with our stock accounts?
Because the biggest bottleneck for enterprise AI is outdated applications and unstructured silo data. By integrating IBM's watsonx technologies directly into ServiceNow's platform, IBM places itself at the exact center of enterprise IT operations. They are directly solving the data governance and orchestration problem for the world's largest companies, allowing them to deploy AI on their own strict terms. Wow, okay. So they're the ultimate bridge. They're basically telling big corporations, hey, don't throw away billions of dollars of legacy tech. We will just modernize it for you.
Exactly. The source material explicitly defines this as a connective tissue play, and it is a massive differentiator. Enterprises absolutely refuse to rip and replace their legacy systems because it is far too costly and way too risky. An interruption of service could mean millions lost in minutes. So by modernizing what already exists and securely connecting it to new AI capabilities, IBM makes itself completely indispensable.
But wait, why wouldn't these huge corporations just hand all their data over to the public cloud giants? Isn't that what literally everyone else is doing?
No, not for their most sensitive proprietary data. If you look at the software segment breakdown highlighting hybrid cloud, automation, data, and transaction processing, it illustrates their moat perfectly. Enterprises want to retain absolute control of their proprietary data to train their own AI models safely. They do not want to be locked into a single public cloud provider where their data might be compromised, leaked, or used to train public models. IBM's focus on open source, flexible, on-premises, and hybrid models led by Red Hat OpenShift allows enterprises to run AI workloads wherever they perform best. It gives them the flexibility to write a program once and run it anywhere, all under their own operational authority.
Okay, that makes total logical sense, but you mentioned earlier there was a massive, unpriced regulatory catalyst hidden in the news. What exactly is that about?
This is a crucial piece of data that the market is completely overlooked due to the consulting panic. The White House recently shifted the federal quantum encryption deadline. Originally, federal agencies had until 2035 to upgrade their cryptography to withstand quantum computer attacks that could instantly break current RSA encryption. That deadline has been aggressively accelerated to 2031.
Wait, 2031? That is basically tomorrow in government time. How does that help IBM?
It creates an immediate, mandated market for IBM's security software, specifically tools like the Z-Secure Secret Manager, which automates certificate replacement and fortifies systems against quantum threats. The pipeline for IBM's security and mainframe hardware just got filled with urgent, federally mandated demand. This is a massive, multi-year tailwind for their infrastructure and software segments.
Okay, so they have a $12.5 billion AI backlog, a crazy 48% mainframe growth surge, and the federal government is basically forcing clients to buy their security tech. But look, I have to interrupt the good news parade to play devil's advocate again here. We absolutely cannot ignore the fatal weakness. What about that consulting drag? You said it only grew 1%. If consulting freezes up completely, does this whole bullish thesis just fall apart?
It is a valid risk that must be addressed logically. The data confirms the consulting segment grew just 1% at constant currency, totaling $5.3 billion. Clients are highly cautious with discretionary IT spending due to elevated interest rates, which make funding massive new infrastructure projects very expensive. However, even within consulting, the strategic components are shifting. The generative AI book of business is actually growing rapidly. But yes, as long as macroeconomic fears persist, this segment will remain a persistent drag on overall top-line growth and investor sentiment, making it the primary headwind for the stock in the near term.
All right. Stage 4, survival scenarios. Okay, we know the legacy consulting business is an anchor right now. I need a bottom-line forecast. Based purely on the hard data, what are the actual odds for investors moving forward? Understood. Based strictly on the Q1 2026 data trajectory, we have 3 distinct scenarios. First, the bull case. The triggers here are the $12.5 billion AI backlog converting to revenue rapidly, and the White House quantum mandate driving sustained double-digit infrastructure growth. If consulting stabilizes even slightly, returning to mid-single digits, IBM's overall margins will explode upward. The feasibility is high, given the 48% Z mainframe growth and 16% data software growth we already see in the financials. The market would be forced to re-rate IBM as a true AI platform, driving the stock significantly higher. Second, the base case, which is the most likely. Software and infrastructure continue their solid high single-digit and low double-digit growth, perfectly offsetting the stagnant 1% consulting growth. Margin expansion continues due to internal AI productivity savings, securing the $1 billion free cash flow increase projected for 2026. The stock recovers its 20% drop as the market realizes the Accenture fear was fundamentally misplaced. Third, the bear case. The trigger here is a severe macroeconomic recession that causes the consulting segment to completely freeze, dropping into negative growth while enterprise budgets for new AI projects evaporate. The feasibility is moderate. However, even in this scenario, IBM's $24.6 billion in software ARR and their massive, historically high free cash flow provide a defensive floor that prevents a total structural collapse.
Wow, that is incredibly clear. So we have a company that just printed its highest Q1 free cash flow margin in history, expanded its software footprint massively, saw a 48% surge in mainframe demand, and sits on a $12.5 billion AI backlog. Yet the stock dropped 20% because a completely different company issued a warning about consulting. It perfectly brings to mind the legendary Benjamin Graham quote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." The emotional voters panic-sold the stock in June, but the fundamental mathematical weight of that software recurring revenue and cash flow is absolutely undeniable.
Which leaves us with the ultimate question: will investors wait long enough for the $12.5 billion AI backlog and the White House quantum mandate to fully ignite, or will they get shaken out by the short-term noise? That is something you have to weigh for your own portfolio. Thank you so much for joining us for today's Explainer. If you found this deep dive into the real data helpful, your subscriptions, likes, and supportive comments are a huge encouragement for our production team. We will see you in the next one.